Hello and welcome to Rewind 2024. I'm Arundhati Ramnan. As 2024 draws to a close, the stock markets are closer to providing double-digit returns to investors. This is largely thanks to the rapid rise in the mutual fund industry and new fund offers in particular. Sonal Bhutra tracks the rise of NFOs and maps the fund flowing into the mutual fund sector. Take a look.
2024 saw a lot of action in the mutual fund space, and funds raised via NFOs has definitely been one of them. Let's look at the numbers. Funds raised by NFOs or new fund offers stood at 1.04 lakh crores in 2024. This is still the month of November. And we have more NFOs in the month of December that has not been accounted for here. That is an uptick of 63% versus funds raised in 2023 at around 63,800 crore rupees. Now, this was slightly lower than 2022. That time, the number was 67,336 crore rupees. But 2021 also saw massive inflows. This was double the amount versus 2020, when the amount raised was around 53,700 crore rupees. Now, if we talk about the number of NFOs, 2022 still tops the list. So far in 2024, we've seen 205 NFOs which have been issued till November. This compares with 212 in 2023, 246 in 2022, 140 in 21, and around 81 in 2020. Some of the categories that saw high flows: multi-cap funds getting in 6,300 crore rupees of money, and other ETFs at around 1,400 crore rupees. But the real star of this year had to be sectoral funds. 40 sectoral or thematic funds have seen the highest flows that we have seen in the last 5 years. Sectoral funds garnered around 67,772 crore rupees in 2024 so far, which is more than the flows in this space from 2020 to 2023. In this period, sectoral funds garnered around 52,165 crore rupees. This is via 59 NFOs. Even index funds actually saw a lot of interest. 76 NFOs in the index fund space, raising 12,147 crore rupees, which is the highest that we have seen in at least 5 years. Index funds have always seen a lot of interest, and more so in the last 3 years, with more focus on passive investing. In 2023, 53 index funds were launched, garnering around 2,700 crore rupees. This compares with 85 in 2022, and these numbers were very low in 2021 and 2020, as you can see on your screen. Interestingly, no mid-cap funds were launched in 2023 and 2024. This space did see a big rally, but did not see a new product here, but saw massive flows in the existing names. Also, only one small-cap fund was launched in 2024. And now we are towards the end of 2024, and December also has seen a lot of action in the NFO space. But will this continue in 2025? Will there be new products by mutual funds houses to diversify their portfolio? Well, time will tell.
Sonal outlining how the mutual fund industry did in 2024, but from mutual funds to microfinance. 2024 saw the sector face significant headwinds. Assets under management has declined. Bad loans are on the rise. Abhishek Kothari reports that 2025 promises to be yet another challenging year.
Rural economy came under great pressure during the large part of CY 2024, that is calendar year 2024, especially in the microfinance segment. The sector is expected to see pain in its business going into 2025 as well. Let's take a look at the numbers. So AUM growth, that is asset under management growth, which was at 26% YOY last year, that is in 2023, has declined to less than 9.5% growth year on year this year so far. So growth is expected to further slow down as lenders battle various issues ranging from over-leveraging of customers to credit costs to asset quality pain, etc. So the biggest impact has been seen for Spandana Spurti, ESAF SFB and Credit Access Grameen in 2023. All the lenders saw improvement in their asset quality, but in 2024, ex of Satin Credit Care, all of them witnessed huge pain in their asset quality. Highest pain was seen in Fusion Finance. Amount-wise, these lenders saw gross NPA decline by 32% in 2023, and then it rose by 79% in calendar year 2024 so far. Massive rise was seen for Fusion Finance, Spandana Spurti and Credit Access Grameen. They saw their stock price and valuations also decline due to lowering of growth and deterioration in the asset quality. Now, highest decline in valuations on a one-year forward price to book value has been for Credit Access Grameen, Fusion Finance and Equita Small Finance Bank. marginal improvement was seen in lower valuations of Ujjivan Small Finance Bank and Utkarsh Small Finance Bank, now underperforming Nifty this year so far. On year-on-year basis, while Nifty has given a return of 17.3%, these lenders have given negative return ranging from as low as 5% to as high as more than 67%. So from 52-week high, if you take a look, Nifty has given a negative return of almost 7%, while these lenders have given negative returns ranging from as low as 31% to as high as 73%. Highest negative return is from Fusion Finance, followed by Spandana Spurti and then Credit Access Grameen. Let's look at the outlook for 2025 given by ICRA on this sector. Stricter lending norms for microfinance shall improve the credit safeguards, but will pose challenges to near-term outperformance or the performance of the sector. Borrower rejection rates are projected to increase significantly as over 20% of the borrowers are expected to be impacted by the new guardrails set by MFIN. Now, NBFC MFI's AUM growth will compress to 0 to 5% growth in FY25 from 29% that they had in FY24. Credit cost is expected to be at a high range of 5.4% to 5.6% for FY25, along with margins is expected to compress the overall profitability of the sector. The sector has challenges stemming from over-leveraging of the borrowers, socio-political disruption, as well as operational challenges largely related to the high employee attrition seen over here. There is significant downside risk to the near-term loan quality of the sector. ROA or return on asset can decline massively for the lenders in large part of 2025. They are strongly capitalized. Hence, incremental capital requirement for loan growth will be lower due to expectation of slowdown in the overall loan growth of the sector.
2024 saw a flurry of welfare schemes being announced as the country and several states went to polls. Some of these walked a fine line between being handouts and truly welfare-oriented, but they have paid off politically speaking. On Rewind 2024, CNBC-TV18 Santhya Gora looks at some of the key welfare schemes of 2024 and reports that with most states heading to polls in the next 2 to 3 years, more such schemes cannot be ruled out.
It's not odd to see a surge in the number of welfare schemes that are born in an election year. But 2024 took this to a whole other level. Not only did the country hold its Lok Sabha elections early this year, people in 8 states came out to choose their state governments. It's not surprising then that this meant new welfare schemes being promised by parties and being launched by incumbent governments. It wasn't just poll-bound states that stepped up their welfare spending. Madhya Pradesh and Tamil Nadu continued their women-centric schemes. Nor were such schemes directed solely at women. In all, 2024 saw over 740 welfare schemes in operation, ranging from free health insurance for weavers to increasing the scope of the midday meal scheme for children in schools, to income support for farmers, to incentivizing rooftop solar panels for electricity generation. Naturally, all these come at a cost. In Maharashtra, for instance, the Ladki Bahin scheme, which promises 1,500 rupees a month to every female resident between the age of 21 and 65 years, is projected to cost the state 46,000 crore rupees. The addition of schemes like these has pushed the state's fiscal deficit beyond 2 lakh crore rupees, taking it above the ceiling of 3% of gross state domestic product. In Himachal Pradesh, meanwhile, populist measures like the old pension scheme and monthly payments to women have left the state struggling to pay government salaries. It has taken drastic measures to tighten the belt, even shutting down government hotels and scrapping old welfare schemes. Karnataka and Rajasthan are also grappling with delayed payments and financial crisis due to their poll promises.
When you are pushing your fisc in, supporting schemes which are not necessarily leading to any productive gain in the economy and also lead to massive disorder in terms of labor market or distortion in terms of labor market, they clearly would not only impact your fiscal in terms of pure skewness, but also will impact the overall productivity of the economy, which will impact the nominal GDP in the medium term, which is the denominator in your fiscal deficit management.
That would really depend on how these freebies, so to say, are getting financed. If it is at the cost of capital expenditure, then that is definitely something that is not very encouraging in the long run. It would have an impact on the state's competitiveness and its potentially its ability to raise revenues in the future.
According to a study by economists, 16 states have together launched over 100 such schemes since 2020, and the cost of 2/3 of these schemes is pegged at 5.1 lakh crore rupees. That's 1.6% of the country's GDP. A separate report by CRISIL says that 11 states in India are set to spend a record 4 lakh crore rupees on welfare schemes. That's 13% of their total expenditure. In contrast, these states are spending only 10 to 11% of total expenditure on education, 6 to 7% on power, 6 to 7% on agriculture, and 4 to 5% on health. This is something N.K. Singh, the chairperson of the 15th Finance Commission, has cautioned against. He called them, and I quote, a passport to fiscal disaster. Experts worry the number and scope of welfare schemes could get worse in 2025, especially as important states like Bihar and Delhi ready for elections. Many state governments are already grappling with the financial fallout of existing welfare schemes. But these schemes are seen as having borne political fruit in the past. So unless the electoral efficacy of these schemes reduces or political parties find other measures that they feel will work as well as a victory formula, the trend is unlikely to change. It then becomes vital that state governments and political parties strike a balance between welfareism, populism and fiscal discipline. In Mumbai, with camera person Ajay Dabholkar, this is Santya for CNBC-TV18.
On that note, it is time for us to head into a short break. But coming up next, 2024 saw crucial developments as India attempts to transition towards clean energy. We take stock of the progress after this short break. Stay tuned.
Well, the consolidation theme continued to play out in 2024, with 40 million tons of capacity folding up into the hands of Adani Cement and Ultratech. And over the years, Adani's foray into the cement space with a massive war chest has acted as a catalyst, triggering the race for capacity share, which has increased the competitive intensity. The top 5 players now account for more than 60% of the market. That compares with only around 40% 7 years back. The question is, will consolidation slow down from here on? Remember, the recent deals have been concluded at around $100 per ton mark. That's closer to replacement cost. Well, ICICI Securities says that cement majors like Ambuja as well as Ultratech, they've exhausted most of their cash reserves post the recent acquisitions. They add, except for a few NCLT cases, they believe that low-cost acquisitions are largely behind. And now the potential deals may command a significant premium to the replacement cost. That could make them much more unattractive on borrowed funds at low cement prices. Well, the pain point is elevated competitive intensity has led cement prices plunging to 4-year lows. Demand as well has been plagued by general and state elections, heavy rainfall in few regions of South India, the construction ban in NCR region, and also labor unavailability in various parts of the country. But part of the street is optimistic that cement sector has hit rock bottom and it's ready to fight back. Well, Jeffrey says that dealers suggest that price declines have bottomed out, and now the industry is attempting price increases every month. They believe that the recent increase in industry consolidation further supports a case of revival in cement prices. Though sustainability of the price hikes will depend on what the leaders prefer, volume or price increases. Well, Goldman says that their channel checks suggest that demand is recovering, though on a low base. With the expected pickup in government capex, rural demand is likely to improve, and urban real estate market, well, that's doing well as well. So they expect that cement demand will grow by around 7% in FY26. On the profitability aspect, well, INCRED says that lower fuel cost, improvement in volumes, that could lift EBITDA per ton by around 160 rupees on a sequential basis. Though they
2024, solar cell players have had a stellar run this year, with stocks of Premier Energies, Waaree Energies and Tata Power rallying up to 170%. Vivek Iyer decodes the rally and what lies ahead.
Well, one particular pocket of the market that did very well in 2024 was the entire solar value chain. just have a look at some of the companies that are involved in solar cell module manufacturing and see the kind of returns that they've given to the shareholders. Now, this particular stellar rally can be attributed to several key factors. As India continues to push towards ambitious renewable energy targets, there has been a substantial increase in domestic demand for solar products. Remember, the USA too has seen an increasing demand for solar energy solutions as part of its broader clean energy transition. The Inflation Reduction Act, passed in 2022, includes significant incentives for clean energy production, including solar power. Both India as well as the USA are keen on reducing their dependence on Chinese imports, particularly in sectors like solar energy, given the fact that the US has concerns over its supply chain security, intellectual property, as well as its ongoing trade tensions with China. These particular tensions have driven a desire to diversify sources of solar products. India, on the other hand, is positioning itself as an alternative supplier, benefiting from the global desire to avoid over-reliance on China. Both the USA as well as India have implemented policies to curb the influx of cheap Chinese solar products into their market. Remember, players in the India's solar sector are quite optimistic about growth prospects driven by a strong order pipeline as well as expansion plans. Remember, Premier Energy has reported a significant order book worth approximately 4,000 crore rupees. Waaree Energy plans to increase its manufacturing capacity from 13 gigawatt to 21 gigawatt by the end of FY27, while Tata Power reported a strong order book of 15,900 crore rupees in its solar EPC business. Its cell as well as module manufacturing capabilities are also being ramped up as far as Tata Power is concerned. Now, talking about the entire solar value chain, remember, China controls 90% of the world's solar module as well as cell manufacturing capacity. This makes China the dominant player as far as the global supply chain is concerned. Solar manufacturers are actively looking for alternate routes to enter the global markets. Remember, pricing as far as solar modules are concerned in China are at a very competitive 9 to 10 cents per watt, owing to the country's massive manufacturing capacity, economies of scale, as well as cost efficiencies. Now, remember, when you're talking about India, the prices are much higher at 16 to 17 cents per watt, and the USA prices are significantly higher at around 25 cents per watt. Remember, when you're talking about ongoing capacity addition, India's largest conglomerate, Reliance, is on track to commission its first tranche of its solar PV manufacturing by the end of FY25. Also plans to scale up its solar manufacturing capacity to 20 gigawatt by CY26. Adani Group too plans to increase solar manufacturing capacity to 10 gigawatt by 2027. Remember, not only them, other players too have evinced interest to set a facility as India's solar manufacturing sector expands rapidly. However, several crucial questions arise concerning the sustainability of current industry dynamics and the challenges that will be posed by increased competition. Remember, India's solar manufacturers, along with their counterparts in the US, are benefiting from a price arbitrage advantage in comparison to global markets, particularly that by China. In markets like the USA, tariffs on Chinese-made solar products have made domestic production more competitive, benefiting the Indian exporters. The Indian government has introduced import duties on solar panels and cells, particularly from China, to protect the domestic manufacturing industry. To promote domestic manufacturing, ALMM is a critical regulatory safeguard that ensures only approved solar manufacturers' products are used in government-supported projects. Analysts, however, are worried about the supply glut in coming years. Will spreads Indian players enjoy be impacted? As the table indicates, when you're talking about valuations, Indian players are actually enjoying a significant premium to global peers both in India as well as China. Remember, some of the listed peers in other markets enjoy larger product portfolios. Some global players also own separate polysilicon as well as ingot as well as wafer facilities. So going into 2025, it will be a cautious stance that analysts will keep as far as the entire solar value chain is concerned.
So Vivek there outlining what solar cell players can expect in 2025. But India's automobile industry has more than tripled in size in the last decade. As the industry aims to get on par with global peers, a shift towards cleaner fuels is necessary to maintain sustainability. Sudarshan Kumar has more on the industry's bid to move away from fossil fuels.
In 1983, India's automobile revolution was ignited with the launch of Maruti 800. Affordable, reliable and aspirational. It became the people's car, and since then, India's automobile industry grew exponentially. Today, India is the third largest automobile market globally. In last 10 years, the industry has tripled in value, from Rs 7 lakh crore in 2014 to Rs 22 lakh crore in 2024. But even with this growth, we are only half the size of China and a quarter of the US market. The goal to surpass both within the next decade.
Now in world, USA is number one. They have the size of auto industry of 78 lakh crores. China is 47 lakh crores and India is 22 lakh crores. Now we have a target that within 10 years, we will be number one in the world because of alternative fuel and biofuel.
And how will we do it? The answer lies in a new kind of fuels. The shift will be driven by three key factors. First, emission targets. India aims to cut carbon emissions intensity by 45% by 2030. Second, reducing fuel imports. Did you know that India imports 90% of its crude oil, spending $71 billion annually? Third is cost savings. Clean fuel vehicles are cheaper to operate. For instance, running a CNG vehicle costs just rupees 1 per kilometer compared to rupees 2.25 for petrol. So what are those alternative fuels that will drive the future? First up, electric vehicles or EVs. India's EV market is set to grow from $23 billion in 2024 to $118 billion by 2032. The government's target? 80 million electric vehicles on Indian roads by 2030. But EVs aren't the only players in the game. Hybrids are bridging the gap. These vehicles combine electric power for short trips and fuel for longer journeys. They are cost-efficient, eco-friendly, and ideal for a gradual transition to clean energy. Next up is ethanol. India is aggressively pushing for ethanol-blended petrol, targeting 20% blending by 2025. Brazil serves as a global example, using ethanol to replace up to 20% of its petrol imports, with 80% of its cars running on ethanol-blended fuel. Brazil has significantly cut its oil dependence. India could follow a similar path. We also have CNG and LNG. They are cleaner and more affordable alternatives to petrol and diesel, and their adoption is growing rapidly. Sales of CNG passenger vehicles surged by more than 30% year-on-year in the first half of FY25, and the market is expected to grow at a CAGR of almost 7% in next 6 years. Last is hydrogen, the fuel of the future. Clean, versatile, and sustainable. It's a game changer for heavy vehicles like trucks and buses.
Hydrogen is the future. And the green hydrogen is the future. Because by electrolyzer process making hydrogen, for 1 kg of hydrogen we need 150 units of power. Now the municipal waste are by using biotechnology generating biomass using for getting it methane in biodigester, and from that methane we can convert into hydrogen or we can convert into CNG.
2025 is not just another year. It's the year when clean fuels take the driver's seat in India's automobile story. Over 40 new car models are expected to hit the Indian roads in 2025. And guess what? Only 20% of them will run on petrol or diesel. And that too, with most of them having the hybrid option. The future of mobility is here, and it's cleaner than ever. Electric vehicles, or EVs, are set to dominate 2025. From Maruti to Tata, Mahindra to Mercedes, every major automaker is going all in on EVs. The goal? To accelerate towards 30% EV adoption by 2030. And that is up from just 6% today. But EVs aren't driving the change alone. Ethanol-powered vehicles are making headlines. As per Roads Minister Nitin Gadkari, big names like Tata, Mahindra and Hyundai are set to launch 100% ethanol-powered cars within the next 6 months. Meanwhile, CNG is steadily solidifying its place as a preferred fuel option in India's green mobility shift. In 2025, Honda is set to join Maruti, Tata and Hyundai in offering CNG-powered models. Tata will introduce the Curvv in a CNG variant, while Maruti plans to launch next-generation CNG versions of its popular Ertiga and Brezza. Adding to the momentum, Honda is expected to unveil a CNG variant of its Amaze sedan. The future of India's roads is not just about speed, it's about sustainability. It's the year clean fuels go mainstream.
All right, Sudarshan, thank you for taking us through what the future looks like for India's auto industry, which is a move away from fossil fuels. But with that, it is a wrap on this special edition. The news continues right here on CNBC TV 18.